The date, October 2025. The price of a single Bitcoin, over $126,000. A symbol of a new financial dawn, powered by institutional adoption and a seemingly unstoppable wave of optimism. And then it cracked. In a matter of hours, $19 billion vanished. Not from hacks, not from fraud, from the simple, brutal mechanics of the modern market. 1.6 million trading positions obliterated. This was the single largest liquidation event in cryptocurrency history. A warning shot fired across the bow of every investor. This is not a story of a crash. This is a story of the engine behind the crash. Welcome to the volatile, interconnected, and leveraged reality of Bitcoin in 2025. Welcome to a world where the biggest risk isn't just the price going down, it's how fast it falls and who gets wiped out on the way. 2025 was supposed to be the year crypto grew up, the year it went mainstream. And by many measures, it did. The US government launched a strategic Bitcoin reserve. Giant corporations, led by figures like Michael Saylor's MicroStrategy, were buying more Bitcoin each day than the entire mining network could produce. The institutional green light was shining brighter than ever. Yet, here's the paradox. Despite this historic influx of legitimacy and capital, Bitcoin was on track for its first annual decline since 2022. From its glittering peak above $126,000, it stumbled, repeatedly testing levels like $86,000. Altcoins fared far worse, many down 60% or more. Why? Because beneath the surface of institutional adoption lies Bitcoin's ancient, volatile heart. Since 2015, its annualized volatility has been over 54%, more than 4 times that of the S&P 500. In its short life, Bitcoin has endured over 34 bear markets, declines of 20% or more. That's an average of 3 to 4 per year. 2025 didn't break this cycle. It supercharged it with new, powerful forces. The signature financial event of 2025 wasn't a slow bleed. It was the rapid, violent liquidation cascade. Picture this. It's early December, Asian trading hours. Liquidity is thin. Bitcoin dips, just 5%. A move to around $86,000. Seems manageable, right? But in that move, $646 million in leveraged bets are automatically, forcibly closed. 90% of them were bets that the price would go up, longs. On exchanges like Binance and Bybit, single orders worth over $14 million were wiped out in an instant. This scenario repeated all year. A volatile hour, 116 million gone. A 24-hour storm targeting Ethereum and Bitcoin longs, 213 million evaporated. Each event followed a similar script. A trigger, a hawkish comment from the Federal Reserve, a surprise announcement on US tariffs, or simply, weak holiday trading volumes. Then, the dominoes fall. Prices drop. Over-leveraged positions hit their liquidation points. Platforms automatically sell the collateral to cover the losses. That forced selling pushes the price down further, triggering more liquidations. A negative feedback loop of selling, fueled not by conviction, but by mechanics. These events acted like a brutal purge, clearing out crowded, overconfident bets. Social media lit up with terms like liquidation cascade. Whales placed massive, targeted shorts, betting millions on the next flush. The market became a game of survival, where the biggest hazard wasn't being wrong. It was being over-leveraged. But why was 2025 so prone to these triggers? Because Bitcoin is no longer an island. Our research indicates its correlation with traditional markets strengthened significantly. Its price movement became more closely tied to the S&P 500 and the tech-heavy Nasdaq 100 than in years past. Bitcoin had firmly become a risk-on asset. This meant it was now exposed to the fears and frenzies of the entire global economy. The speculative fever in AI stocks, the towering U.S. national debt, erratic geopolitical policies. As economist Kenneth Rogoff warned of an epic buildup of global risk, Bitcoin was now wired into that same nervous system. The most powerful connector? The Federal Reserve. Every hint of delayed interest rate cuts sent shivers through stocks and crypto alike. Every piece of hot inflation data could trigger a sell-off. Conversely, the mere anticipation of a rate cut provided a temporary boost. Bitcoin's price action became a real-time referendum on macroeconomic sentiment. The risks are now shared, intertwined. A crash in tech stocks could easily spill into crypto. A liquidity crisis in emerging markets could trigger a flight to safety or a fire sale of assets. The dream of Bitcoin as a decoupled, independent asset faded in 2025, replaced by a complex and often dangerous relationship with the old financial world. And into this volatile, interconnected arena, we pour the most dangerous ingredient of all: extreme leverage. Imagine betting $100, but controlling 10,000. That's 100x leverage. The potential for gain is intoxicating. But in a market that can swing 5% in an hour, it's a recipe for ruin. The math is merciless. A move of just 1% against your position at 100x leverage means a 100% loss. Your position is automatically closed, liquidated, to zero. This isn't just losing. It's being forcibly ejected from the trade. The pitfalls are numerous. Liquidation cascades, which we've seen, turn your neighbor's misfortune into your own. Funding rates, complex fees on perpetual contracts, can silently eat into positions. And then there's the 24/7, unrelenting pressure of the market itself. This environment preys on psychology. Confirmation bias leads traders to ignore warning signs. Anchoring to past highs like $126,000 makes them hold on to losing bets, hoping for a return that never comes. The fear of missing out, FOMO, pushes novices to use leverage they don't understand. Former executives from failed exchanges have called this level of leverage on volatile assets a major problem. It turns the market into a casino where the house and the cold, automated liquidation engine almost always wins. For those who navigate it, the rules are strict. Risk only 1 to 5% of capital on any single trade. Use stop losses religiously. Understand that tools like isolated margin can limit your disaster to a single bad bet. Some use AI bots to remove emotion. And the most contrarian see opportunity in the wreckage, buying when fear is at its peak, right after a cascade. So, what lies ahead in 2026? Some analysts predict Bitcoin's volatility could finally fall, perhaps even dipping below a stock like Nvidia. As institutional involvement deepens and matures the market, the Wild West phase may slowly be settling. But the risks are far from gone. There are still warnings of a potential Bitcoin winter. The ties to macroeconomic fragility remain. The leverage buttons on exchanges haven't been removed. For the intelligent investor, the lessons of 2025 are clear. First, understand what you own. Bitcoin is an asset of immense potential, but it is not a stable one. Its cycles are violent. Second, respect the connections. Watch the Federal Watch equity markets. In today's world, you can't just watch the crypto charts. And third, approach leverage not as a tool for riches, but as a potential detonator. As one trader on social media perfectly put it, leverage is a wild drug. The goal is not to avoid the volatility, but to survive it. To build a dynasty of wealth requires patience, diversification, and the discipline to manage risk when the crowd is chasing euphoria or paralyzed by fear. The story of 2025 is the story of a market growing up painfully. It's a story where billions can be created and destroyed not in years, but in hours. And it's a powerful reminder that in the quest for fortune, the most important investment you can make is in your own understanding. For Macro Dynasty, I'm your narrator. Until next time.